There is a specific number that haunts the global silver market. It is a psychological barrier that has stood firm for nearly 45 years. That number is $50 per ounce. To the average observer, the chart of silver looks like a volatile mess of random noise and market sentiment. But to a financial historian, it reveals a crime scene where the victim is the free market and the weapon is hidden in plain sight. Twice in modern history, silver has attempted to break through this $50 ceiling. The first time was in January 1980. The second time was in April 2011. On both occasions, the price did not just fall naturally due to exhaustion, it was murdered. It collapsed with a speed and violence that wiped out billions of dollars of wealth in days, leaving retail investors confused and bankrupt. The mainstream financial media, from the television anchors in New York to the newspaper editors in London, will tell you these crashes were natural market corrections. They will tell you that buyers simply ran out of money or that industrial demand suddenly vanished overnight. They will show you charts of bubbles bursting and lecture you on the dangers of speculation. That is a lie. The truth is much colder, much more calculated, and far more disturbing. The reason silver stops at $50 is not because of free market forces like supply and demand. It stops there because the system is designed to stop it there. When silver moves too fast, when it threatens the stability of the bullion banks who are short the market, the exchange does not stand by idly. They do not watch their member banks suffer catastrophic losses. Instead, they reach for a weapon that is invisible to the retail investor but deadly to their portfolio. It is called the margin hike. Most people think of the financial market as a place where you buy something and its price goes up or down based on its value. But the futures market does not work like that. It is a system built on leverage and debt. And because it is built on debt, it is fragile. It relies on confidence and continuity. When an asset like silver begins to rise vertically, it breaks the continuity. It creates a stress test that the system cannot afford to fail. In this video, we are going to expose exactly how this mechanism works. We are going to look at the undeniable facts of 1980 and 2011. We will strip away the complex financial jargon to show you the raw mechanics of control. You will see how the rules are changed in the middle of the game to ensure the house always wins. And most importantly, we will discuss why the next run to $65 might trigger the biggest and most desperate intervention we have ever seen in financial history. This is not a theory. This is the history of money that they do not teach you in school. To understand how the game is rigged, you must first understand the battlefield. The COMEX is the primary venue where silver futures are traded. Its mandate is to ensure orderly markets, but order in this context does not mean fairness, and it certainly does not mean transparency. It means survival for the clearing members. Here is the secret that they do not tell you on CNBC. The system does not fear high prices. A high price for silver is manageable if it takes 10 years to get there. What the system fears is velocity. Velocity is the speed at which the price changes. If silver rises to $100 over a period of a decade, the bullion banks can manage it. They can hedge their exposure. They can slowly adjust their books and pass the costs on to consumers. But if silver rises to $50 in 2 weeks, that is a systemic threat. Velocity kills leverage. In the futures market, almost no one buys silver with 100% cash. They use leverage. They put down a small deposit, sometimes as low as 5% or 10% of the contract value, to control a massive amount of silver. This deposit is called margin. Under normal conditions, margin requirements remain stable and predictable. But when the price of silver starts to run away, when the shorts are bleeding capital and the clearinghouse is at risk, the exchange suddenly announces that it costs more money to hold the same position. They will tell the public that this is done to reduce volatility. That sounds prudent and responsible. It sounds like they are protecting you. But let's look at the math. When margin is raised by 20% or 30% overnight, it creates an asymmetric shock. Imagine you are a large institution or a bullion bank. You have deep pockets. You have access to the Federal Reserve window. You have billions in liquidity. For you, wiring additional capital to meet a margin call is an inconvenience. It is nothing more than a cost of doing business. You simply move numbers on a spreadsheet and the problem goes away. But now imagine you are a speculator, a retail investor, or even a mid-sized hedge fund. You are already fully leveraged to maximize your gains because you believe in the trade. You do not have millions of dollars sitting in idle cash accounts waiting to be deployed. When the margin hike hits, you are faced with a forced decision, a decision that must be made in minutes, not days. You have two choices. Choice 1 is to wire more money immediately to cover the new requirement. Choice 2 is to sell the position at the current market price. Since most participants cannot find the cash instantly, they are forced to take choice 2. They must sell. And this is where the cascade begins. When thousands of traders are forced to sell at the exact same time, it creates a wave of artificial selling pressure. The price does not just dip, it crashes. The momentum is broken, the technical charts are ruined, the trend is destroyed, and the banks who are shorting the market are saved. It is a perfect mechanism. It allows the house to change the rules in the middle of the hand, and it works every time. It is a brutal filter that separates the insiders from the outsiders, and the outsiders are always the ones left holding the bag. We do not need to rely on theories or speculation to understand these tactics, because history has already provided the evidence. The blueprint for market intervention was written in blood nearly half a century ago. Let us go back to the late 1970s, a time of rampant inflation, political instability, and a losing distrust in fiat currency. In this environment, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, along with several wealthy partners from the Middle East, recognized a fundamental truth. They realized that the US dollar was losing its purchasing power rapidly and that silver was historically undervalued. They decided to protect their wealth not by buying stocks or bonds, but by accumulating massive amounts of physical silver. Their buying pressure was relentless, and it was real. They were not just buying paper contracts to flip for a quick profit. They were taking delivery of the metal. This removed physical inventory from the market and created a genuine supply squeeze. The price of silver responded exactly as a free market should. It exploded from $6 an ounce in 1979 to a peak of $50 an ounce in January 1980. This vertical rise was a victory for hard assets, but it was a nightmare for the establishment. The short sellers, which included some of the most powerful banks and brokerage houses on Wall Street, were facing absolute ruin. If the price had gone to $60 or $70, these institutions would have been insolvent. The system was staring into the abyss. But the establishment did not accept defeat. On January 21, 1980, the exchange changed the rules. They did not just raise margins, they went much further. They implemented a rule known as liquidation only. This is perhaps the most blatant and aggressive act of market manipulation in financial history. The rule was simple but devastating. Effective immediately, traders were allowed to sell their silver contracts to exit the market, but they were strictly forbidden from opening new buy positions. Think about the cold logic of that for a moment. By decree, the exchange eliminated 100% of the buying demand while forcing liquidation. When buying is illegal and selling is mandatory, there is only one direction the price can go. It is not a market anymore, it's a slaughterhouse. The price of silver did not just correct, it collapsed. It fell from $50 down to nearly $10 over the next 2 months. The narrative sold to the public was that the Hunt brothers had cornered the market and that the exchange stepped in to restore order and save the economy. But the reality is that the exchange stepped in to save the banks who were on the wrong side of the trade. They proved in 1980 that if the house is losing, they will simply close the casino doors, lock the buyers out, and force everyone to cash out at a loss. It was a lesson that the market would not forget for 30 years. For 3 decades, the memory of 1980 kept the silver market quiet. But in 2011, the ghost returned. The context was eerily similar. The Federal Reserve was printing money through quantitative easing, the U.S. debt rating was under threat, and investors were once again flocking to safe haven assets. By late April 2011, silver had climbed all the way back to $49.50. It was knocking on the door of the all-time high. The momentum was unstoppable. Retail investors were piling in, mining stocks were soaring, and the sentiment was overwhelmingly bullish. The market believed that $50 would be broken and that triple-digit silver was inevitable. But just like in 1980, the alarms were ringing inside the clearinghouses. The velocity of the move was too fast for the shorts to handle. The liability was growing too large, and so the response was activated. But this time, instead of one single crushing blow, they used a rapid-fire assault. In the span of just 9 days, from late April to early May 2011, the exchange raised margin requirements on silver futures not once, not twice, but 5 separate times. They raised the cost of doing business by a staggering 84% in barely more than a week. The most critical blow came on a Sunday night, May 1, 2011. Sunday evenings are typically when market liquidity is at its absolute lowest. Most traders are away from their desks, volume is thin, and the order books are empty. It is the perfect time to ambush a market if you want to cause maximum damage with minimal capital. When the electronic markets opened for trading that Sunday evening, the new margin rules took effect instantly. The price of silver was hammered down by $6 in minutes. This event became known among silver investors as the Sunday Night Massacre. It was a psychological operation as much as a financial one. By crashing the price during a low liquidity window, they created a technical breakdown on the charts. When the rest of the world woke up on Monday morning, they saw a massive red candle. Panic set in. The narrative shifted instantly from a bull market to a bubble bursting. Small traders, who had been holding on through the first few margin hikes, finally capitulated. They couldn't afford the new capital requirements, and they couldn't stomach the volatility. They sold at the bottom, handing their positions over to the very banks that had engineered the crash. It was a lesson that the market would not forget for 30 years. We are now standing at the edge of the third great cycle. The economic conditions that fueled the rallies of 1980 and 2011 are not only present today, they are significantly worse. The United States national debt has exploded to over $34 trillion. Inflation is becoming entrenched in the global economy, and geopolitical trust is fracturing. Under these conditions, it is inevitable that silver will once again challenge the $50 ceiling. The energy is building, the pressure is mounting, and this leads us to the most critical question of all: what happens next? When silver eventually breaks past $50 and heads toward $65, we should expect the system to react exactly as it has in the past. The exchange will likely raise margins. They may change the rules. They may even halt trading to cool down the momentum. They will use every tool in their arsenal to defend the status quo and protect the short sellers. However, there is one fundamental difference this time around, and it is a difference that could break the wheel of manipulation forever. That difference is physical scarcity. In 1980 and 2011, there was enough physical silver above ground to satisfy industrial demand. The market was largely driven by investment psychology. But today, We are entering an era of structural deficits. The solar industry alone is consuming a massive percentage of annual mining supply. The electronics industry needs silver. The electric vehicle industry needs silver. These are not speculators who can be scared away by a margin hike. These are industrial users who need the physical metal to keep their factories running. You can print paper contracts, you can raise margin requirements on a screen, but you cannot print molecules of silver. When the physical vaults run dry, the paper price on the COMEX becomes irrelevant. If Apple or Tesla or a solar panel manufacturer cannot source silver at the paper price of $30 or $50, they will pay whatever is necessary to get the metal. At that point, the pricing mechanism shifts from the futures market in New York to the physical market in the real world. That is the breaking point. That is the moment when the margin hikes stop working, because a margin hike can force a speculator to sell a paper contract, but it cannot force a factory to stop needing raw materials. So, what should you do as an investor? The lesson from history is clear. Do not play their game. The futures market is designed for the house to win. It is a trap for those who use excessive leverage. If you try to get rich quick by betting on short-term price movements, you are making yourself vulnerable to the very weapons we have discussed. Instead, play the game where you have the advantage of patience, the advantage of holding the asset without leverage, the advantage of understanding that the price you see on the screen is an illusion maintained by a system that is running out of time. Do not be discouraged when you see the price drop suddenly on a Sunday night. Do not panic when the media tells you the rally is over. Recognize it for what it is. It is a sign of fear from the establishment. It is confirmation that you are on the right side of history. The ceiling of $50 has held for 45 years, but no ceiling can withstand the pressure of reality forever. The next time silver runs, it will likely be the run that breaks the system. Stay disciplined, stay informed, and watch the physical inventories, not the paper price. Thank you for watching. I truly appreciate your time and support. If you found value in this analysis, please subscribe to the channel as we continue to uncover the financial truths that shape our world. I look forward to continuing this conversation with all of you in the next video.